The maths behind credit card. Come closer, pay rapt attention. In this video, I want to show you how banks profit and how you can win. A credit card is neither good or bad. It's the mathematics behind how you use it that determines whether it builds your wealth or quietly drains your money. Most people think credit cards are simply pieces of plastics. Mathematically, they are one of the most profitable financial products ever created. Today, I'll show you the exact mathematics banks use to earn money and how understanding the numbers can save you thousands of dollars. I'm going to be running this explanation in parts for clarity. Few simple, understandable parts. Let's take part one. The credit card connects you direct to your bank. Say a credit card is simply a short-term loan. The bank lets you spend its money today while you promise to pay it back later. So let's get into part two. I'll take a simple example. Let's say you have a credit limit of $5,000 and your purchase is equal to $1,000. Now, say you buy a laptop costing exactly $1,000. Understand that your debt will be equal to $1,000. Leading us to part three. If you pay everything, say your purchase is $1,000 and then you paid before the due date, the interest it will accrue will be equal to zero. If you repay the full amount before the due date, guys, the mathematics is simple. You borrowed $1,000, right? And you return $1,000. Bank's profit will be equal to zero from interest. Taking us to part four. The expensive mistake people make while carrying out this business transaction or exercise with banks. Where you have a purchase of $1,000, your APR equals to 25%. Monthly interest will be 24% divided by 12, which is equal to 2%. APR here means annual percentage rate. Banks convert yearly interest into monthly interest. So let's come to part 5 of this video now. The first month. Your interest in the first month, considering what we're talking about thus far, will be 2%, 2% multiplied by $1,000, and that's equal to $20. Debt will imply $1,020 in the first month. After 1 month, your purchase $1,000 has become $1,020. Then in the second month, which is our part 6 of this video, your interest remains 2% multiplied by $1,020 this time because it is the second month. That will give us $20.40. Hence, your debt is equal to $1,000, $1,040.40 at the end of your second month. Notice something. The bank isn't charging interest only on the original purchase, as you can see demonstrated fully in that second month. The bank rather charges interest on the previous interest as well as on the balance, and that's compound interest. See the formula in this other part of this video, the part 7, where A is equal to the final debt, P is equal to the original purchase, R equal to the monthly interest, and N is equal to number of months involved. This is the same compound interest formula used for investments, but here it is working against you and not for you, because you are in debt and it's counting on your debt. So let's quickly go to part 8 now, where I'm talking about the whole process now in 1 year. In 1 year, substituting into your compound interest formula, P, which is your original purchase, is equal to $1,000. Your R, which is your monthly interest, remains 2%. N, which is the number of months, is always 12, because it is per annum here now, it is after 1 year. Then let's calculate A, which is the final debt that must have been accrued within this 1 year of you having a credit card of $5,000 with which you purchased a laptop of $1,000 a month. So A here will be equal to your 1,000 multiplied 1.02 in brackets raised to the power of 12, and that will be equal to $1,268. This $1,268 interest is without you buying anything else. Your $1,000 purchase has become approximately $1,268 at the end of 1 year. That's $268 paid simply for borrowing money. Welcome to part 9. Part 9 in this video is minimum payment trap. You have a balance of $1,000 and your minimum payment is equal to $30. That sounds good, right? It's not much, right? Okay, so let's take your interest to be $20, where payment is $30. Principal reduced to equal to $10, only $10. Out of your $30 payment, only $10 actually reduces the debt. The remaining $20 goes to interest. That's why some people stay in debt for years. Now, the reward mathematics in credit card. The reward behind credit card mathematics. This is part 10 of this video. Cashback is equal to 2%. Cashback is equal to 2%. Suppose spending $2,000. Calculate reward. If cashback is $2, suppose spending is equal to $2,000. The reward will be equal to 2% multiplied by $2,000, which is equal to $40. Now, if you pay the entire balance every month, you keep the reward without paying interest, meaning interest paid will be equal to zero, whereas reward earned will be equal to $40. Now the mathematics is working in your favor because you pay the entire balance every month. You did not carry over any balance. So let's quickly go to part 11 now of this video, the bank's business model. Say we have 100 customers split into two groups. Group A, who pays $40 in full and their interest is $0 debt. And group B, take group B to be 60 customers carrying over their balance. Average balance will equal to $2,000
for all of them put together.
Interest is 24% multiplied by this $2,000, which is equal to $480 per person
per year.
Now this $480 per person yearly multiply will give you 60 times 480, which is equal to $28,800. This is when the bank is serving 100 customers, and we divided the 100 customers into two groups, group A and B. Group A having $40, having 40 customers and paying back everything in full. They are paying back in full every month. Whereas in group B, you have 60 customers that are not paying back their monthly payments in full, or that they are carrying over. Even though 40 customers paid no interest, the bank still earns $28,800 annually from the other 60 customers. That is why banks encourage responsible spending, but rely heavily on customers who carry balance over. So now, part 12 of this video. Part 12 is good debt versus bad debts. Here are the good debts. The good debts pay full balance and earn rewards, thereby improving credit scores with no interest accrued by compound interest. Whereas the bad debt misses payments and have or incurred compound interest, hence growing in debt, and is liable to late payment fees.
Now part 13
is real life comparison between option A, that pays full with $0 interest,
and keeping a reward of $40. Real life comparison between A and B.
B carry balance interest, which is equal to 268 from the example we're considering here. Hence, $280 and $68 plus $40 will give us $300. The difference between good and bad credit card habits isn't just convenience, it's about mathematics. One person earns $40 another loses $268 on the flip side. That's a total swing of $308 on the exact same purchase that both Group A or Group B did. The bad debt and the good debt did. Now, here is the final lesson. Credit cards are mathematical tools. Always know that. Understand interest if you're working with credit cards and pay before your due date to incur no interest and avoid minimum payments so that you will let the compound interest work for you and not against you. Remember, a credit card is neither good nor bad. It is the mathematics behind how you use it that determines whether it builds your wealth or quietly drains your money. When you understand the numbers, you stay in control, not the bank. If you enjoyed these financial mathematics lessons, subscribe for more videos where we simplify the mathematics behind everyday money decisions and help you make smarter financial choices. Thank you for watching.